pretty much all stocks correlate with each other. So adding more stocks will not give you any value because your portfolio is not becoming less risky in this case. If it falls, they fall altogether. For commodities, that's a different story.
In your opinion, what do you think are some key triggers that move capital between the asset classes?
If we take a look, for example, at the long-term charts for 40 years, so the only ever green rising asset that you see is probably S&P 500 index, whereas commodities have some cycles.
Why don't we go ahead and check on that chart? Hello everyone, and thanks for tuning in for another episode of Exness Trading Talks. If you haven't watched our previous video, it was about hidden signs on silver, gold and natural gas, and I would urge you to watch it because it was quite interesting. Today we are going to talk about commodities and equities, how big players shift between the two, why are some considered safe havens, and some chart reviews. You can subscribe to our channel to watch all of the previous videos and also enable notifications to get updates on our upcoming ones first. My name is Antreas Themistokleous, and today with us we have Stanislav Bernukhov to share his opinions on today's subject. Hello Stan, and thanks for being here.
Hello, Andreas.
All right, so when it comes to commodities and equities, how did commodities specifically perform against stock during past crises or periods of high volatility? Anything that comes in mind?
So basically that depends on the instrument, but generally, of course, if we are dealing with a recession or something concerning, so commodities tend to be pushed down because the consumption is diminishing, so commodities go down. Well, speaking of gold, gold is a protection asset, so that stands aside of other commodities. Speaking of direct relationship with the stock market, there is no direct relationship because commodities basically depend on the supply and demand associated with them and the consumption. Because if we take a look, for example, at the long-term charts for 40 years, so the only ever green rising asset that you see is probably S&P 500 index, whereas commodities have some cycles going like boom and bust cycles,
yes,
going up and down, more like that. So they are context dependent, so they are related with a certain situation, and the price will not, it's not going up indefinitely like it's going on with stocks, for example. In crises, that depends. For example, if we are dealing with the rising inflation, and if the central bank is not taking any necessary steps for fighting this inflation, commodities may get into play as a speculative asset, as an investment asset. For example, that was so from July 2020 until, I guess, the peak in June 2022 for 2 years. Fed was refusing to acknowledge the fact about the inflation. They told us, okay, we don't see the inflation yet. We are not going to raise their interest rate yet. So what else were left for hedge funds and investment managers other than buy commodities? Then they sent signals to the market that, oh, all right, we will raise the interest rate. So commodities started to diminish in this case.
Yeah, after they decided to take action.
Yes,
after two
finally.
2 long years, yeah. Okay, so speaking of cycles and downturns, how does big money or big institutional money managers shift during periods of downturns?
Well, we already mentioned gold, so they might increase their proportion of gold in their portfolios when they have some concerning periods. Then, for example, if they play the certain idea, let's say, like idea around electric vehicles or anything like that, they may increase the proportion of related commodities. Well, might be lithium, zinc, whatever, so related to electromobiles. What else? So, for example, speaking of agricultural commodities, they are not usually the point of speculation and investment. But generally, hedge funds sometimes use commodities because they are not correlated with each other. And that is considered as a plus. Because, for example, if you play the stock portfolio, so pretty much all stocks correlate with each other. So the adding more stocks will not give you any value because your portfolio is not becoming less risky in this case. If it falls, they fall altogether. For commodities, that's a different story. For example, traders who use commodity markets, they might allocate their capital across 30 markets with commodities. There is so-called green gold formula. So your effectiveness rises as a square root from the number of assets which are not correlated with each other. So that's why commodities play a big role in that.
In your opinion, what do you think are some key triggers that move capital between the asset classes?
Well, this year, for example, tariffs, it's a big trigger. We've seen copper falling in summer dramatically after rumors of tariff being imposed on the copper trading. So that's the most obvious one this year. But generally, any substantial change in any macroeconomic indicator might trigger something. For example, some improvement in labor market, some improvement in consumer spending. So it might trigger the growth for commodities, especially if the previous forecast was weaker than the actual publication.
Yeah, like we've seen recently with the US job data that massively missed expectations and created big volatility, and that obviously triggered shifts in capital. Okay, so in shifting capital, let's say into commodities, what are some benefits or disadvantages in doing so?
Well, first of all, commodities are more volatile, so they're more unpredictable in many cases.
Yeah, they create more chances, more opportunities.
You need both liquidity and volatility.
Yeah.
So to capitalize on those chances, sometimes volatility is not your friend.
Yeah.
Because it's pretty different for, to build a position here with planned risk, I would say. Because if, for example, it skyrockets, if it goes higher, so if you position yourself at the right time, that is good. But what if not? So exiting the position might also not be very good. For retail traders, that's okay, I guess. For institutional traders, institutional managers, that's a big problem because unloading a big position on commodities might be a hassle.
Yeah, and carries a lot of risk.
Yes.
Yeah. All right. So you mentioned earlier about how the S&P 500 is more stable in its trend over time. So why don't we go ahead and check on that chart?
Sure. Well, it's again on the all-time high, and as we see it, it's climbing consistently since April 2025, after markets stabilized after the Liberation Day, the so-called day of tariffs announced by Donald Trump. So now it's on the new peak. So that's a typical behavior of the stock market. I would say breadth and strength is pretty good. So, but volatility is also low. For investors, that's good. So you just enjoy your position going up every day. For traders, that is associated with pretty low volatility. If you want to trade every day, so you don't see anything like the choppy type of action with very occasional sporadic moves. And it's not very easy to trade in the short term in such market.
Yeah. Okay. So thank you very much, Stan, for providing your viewpoint.
Yeah. Thank you, Andreas.
And thank you all for watching another episode of our podcast. If you haven't done so already, you can subscribe to our channel to get early notifications on the next episodes in this series with more insights.